you. Welcome, everyone. I'm coming to you from my home office in St. Paul, Minnesota. Gorgeous fall day. So we're going to cover a lot of ground as part of this webinar dealing with the stabilization grants, tax consequences of those grants, and looking at other changes in the tax rules for 2021. We're going to cover what is income and what is not income during this COVID era, how to treat the stabilization grants, what can you deduct as a business expense, how to calculate your time and space percent, particularly if you've been closed for any period of time this year, how to deduct vehicle and food expenses, when should you start claiming Social Security benefits, and a couple comments about the SBA loan programs that are out there. I am a licensed attorney working on helping family childcare providers be more successful as a business. I do that through trainings like this. I do that through writings on my website, as well as answering questions. So if you have any questions after this evening about what I'm talking about or any other business matter, I'm happy to try to answer them. Here's my phone number. Here's my email address. Your question might be answered on my website, tomcopelandblog.com, where I posted hundreds of articles on all aspects of the business side of family childcare. I'm on Facebook. Every time I post an article on my website, it will appear on my Facebook page, and you can ask me questions on Facebook. I've prepared two resources that cover this area a little bit. Record Keeping Guide, that book lists over 1,000 deductions and how to keep track of your records throughout the year. Also done a DVD explaining in detail all the different aspects of record keeping. And both resources are available through Red Leaf Press. Now, I'm not preparing your taxes. So if you need a tax professional, you need to seek one out. As we all know, we're still in the middle of a pandemic. And over the last 18 months, there's been a lot of financial stress out there for childcare providers. There are a few providers who are making as much or more money than they have before the pandemic. But more often, folks I hear from are hurting financially, have closed down temporarily, have closed down permanently. And so we want to look at the tax issues that are rising because of this pandemic. What's different this year, last year? What about state grants? Are those state grants taxable? If you're working more hours because of COVID, how does that impact your tax return? What expenses related to COVID can you deduct? What are the new rules this year for the standard mileage rate and standard meal allowance rate? And what are the rules regarding these SBA loans? Now, as we're going along, you can ask me questions under chat. So feel free to just post questions whenever they come to you. I'll be monitoring them throughout. And because we're a small enough group, at certain points, I'll stop and say, okay, if you want to unmute yourself at this point, you can do that and just talk to me directly. And we'll probably have a little bit of time at the end to do that as well. So let's first talk about income. As is obvious, any money you receive from parents, a subsidy program or the food program, that's income. That's always been income. But what about grants that you've been receiving? Grants are taxable income. And we'll come back to the stabilization grants in a minute. But any grant you received before the stabilization grants are all taxable income. The stimulus checks that we got early this year and last year are not taxable income, not taxable. If you got any money through the Paycheck Protection Program or the Economic Injury Disaster Loan Program, that money is not taxable income. Parent payments. Money you might receive from parents or the subsidy program are still taxable income, even if you were closed when you got the money. So you close for a week, 2 weeks, a month, 2 months, 3 months. And during that time, let's say some of the parents still paid you, part of it or all of it. And perhaps the subsidy program still paid you for a period of time while you were closed. That's still income. If you're open, but some parents didn't want to bring their child to your program because they're still nervous about COVID, but paid you anyway, anything that parent paid you is also income. You don't have to be actually caring for children to have to report any money you get as income. It's always income. Income is reported in the year you get it, not the year you spend it. So if you got a check from a parent December 31st, that's income this year, even though that money might be to pay for childcare for next year. It's when you get it, not when you put it in the bank, when it comes to you. It's income in that year. If you charge parents a holding fee to hold a spot for a prospective parent, to hold a spot for a parent who's nervous about coming back to your program, and if you charge any money for that holding fee, that's still income to you. Now, money you don't collect from parents is not a deduction. So a parent left owing you $400. Well, you can't put $400 down as a deduction on your tax return. You give a discount to a parent. You give a scholarship. You allow parents not to pay you while you are getting this stabilization money. In all those situations, you can't turn around and make that a deduction. All right, so it just means you got less income from that parent, overall less income, pay a little bit less in taxes, but it's not a business deduction. All right, grants. Any New York grant that you've been receiving this year, taxable, as I've said. Now you can deduct the business items if you use some of that grant money for your business. Let's say you got a $1,000 grant and you use that exclusively for business. You'd report $1,000 of income and $1,000 as a deduction. If you got a $1,000 grant but bought something that was used for your business and by your family, you can only deduct the business portion of it. And the business portion we're going to call our time space percentage, which I'll explain later. So let's just say in this example, your time space percentage was 30%. That means you can deduct $300 out of that $1,000. And the other $700 you're going to owe taxes on. So it's quite possible that you will owe some additional taxes for any of the grants that you might have been receiving and are receiving. But paying a little bit more in taxes doesn't mean you're not better off financially. You are always better off financially taking the grant. Paying a little bit extra in taxes means you still have more money left over after you pay the taxes. Whoop, says Vermont. New York, I don't know where that came from. New York has millions of new dollars under this stabilization grant program. And I assume many of you already have this money. And if you haven't, you want to get it. It's taxable income. If you're licensed, regulated, you're eligible. What can you use the money for? Personnel costs, including paying yourself. Increased costs due to cleaning, sanitation, and other COVID-related expenses. Rent, mortgage payment, utilities. Facility improvements in general, or insurance. Goods and services, food, supplies, mental health support. So it's a broad range. There's a lot of different things you can use this money for. But probably the most important thing to understand is you can use this money to simply pay yourself. The language on their website talks about personnel, but you are personnel. If you are self-employed, a sole proprietor, you can just simply pay yourself. If you are a corporation, the corporation reports the grant as income. The corporation then can give you the money through a bonus or raising your wage. But that money that you get as a bonus or a raise has to go through the normal payroll processing of withholding taxes. All right, that's for a corporation. Now, you can use part or all of this grant money to pay yourself. And once you pay yourself, you can then use the money for whatever you want because it's yours now. So you could invest in your own retirement, take a vacation, create an emergency fund, make a major home improvement, adding a deck, buying a new furnace, which are not allowed under the grant that you can spend the money on directly. But once you get the money for yourself, then you can do whatever you want, including buying things that the grant won't allow you to. But you can after paying yourself. Question, we're a part of a church or nonprofit taxable entity. Does the stabilization grant change our status? No, not at all. Not for profit just means you don't pay somebody out the profits. You don't distribute the profits to somebody. All the profit from a nonprofit organization stays within the organization to meet the mission of the organization. So the fact that your program would get tens of thousands of dollars doesn't mean you're not nonprofit. It still means you're retaining the money to benefit the organization and the individuals in the organization. All right, somebody's asking me how much to put aside for taxes. I'm going to get to that. Now, how do we pay for yourself? How do you pay yourself if you're self-employed, sole proprietor? There are three ways. First, if you have more than one bank account, simply transfer the money from the one bank account to another. The other bank account can be business account, personal account, savings account. Just transfer it to some other place. And when you transfer it, you make a note, stabilization grant, paying myself. Secondly, write a check to yourself and cash the check. Put in the memo line, stabilization grant, paying myself. Or leave the money where it is in whatever bank account it ends up in, and just make a note because you're getting paid monthly. So every time new money comes in there, you just write a note to yourself on a piece of paper somewhere that says, on November 4th, I got $2,000, whatever. That's for paying myself. That's it. Now, this concept of paying yourself can be confusing. So one question is, when I pay myself, is then that taxable income again? No. Assuming you're sole proprietor now, you get $10,000. You pay yourself $10,000. You report the original $10,000 as taxable income, but giving it to yourself does not create more taxes. No. If you're a corporation, the corporation reports it as taxable income. The corporation, let's say, turns around and gives it all to you through payroll. The corporation now can deduct all the payroll taxes and the wages to you. And then you, as an individual, must report what you got as a bonus or increased salary as income. So it's only being taxed once. You do not give yourself a 1099. New York will issue a Form 1099 starting in January of next year, but you don't issue one to yourself. No. Question about, is this the same for a town or a government? Well, this is money only going, the stabilization money is only going to family child care providers, group providers, and centers. It doesn't go to a town, doesn't go to a government agency. All right. So I wanted to say it once more because this is something people sometimes having a hard time believing. You can take part or all of this money and just write a note saying that's for me. And that's it. That's all you need to worry about. And you can do it one of these three ways. What are the tax implications now? If you receive a $3,000 grant, you're going to report it as income. If you spend $3,000 on 100% items, you're not going to pay any taxes on it, and you're not going to have anything left over. If you spend it on shared items, things that are used both by your business and by your family, you're going to pay taxes on some of it, and you'll have some money left over. And if you pay yourself the full $3,000, you're going to owe maybe $1,000 to $1,200 in taxes, roughly, and you'll have roughly $1,800 to $2,000 left over at the end of the year. Is this taxable income to the federal government? Yes. Is it also taxable income under your New York tax return? Yes. Yes. Somebody says, I work for a town and run a program, a school-age program. You may be eligible. Well, you probably are eligible for the stabilization grant. And without knowing all the details of your program, you should go ahead and apply and give the state your information, and they'll let you know for sure whether you're eligible. All right, expenses. Now, before I go on, let me just pause here. So this screen summarizes the tax implications. Again, financially, which option are you better off doing? You're better off doing the last one. You're financially better off using all the money to pay yourself. You will pay more in taxes than if you buy stuff strictly for your business or stuff that's used by your business and your family. You will pay more taxes because you're not using the money directly to create deductions for your business. But you will have more money left over. So if you need money to improve the quality of your business, do it. You need to buy a new fence. You need to, you want to take a CDA class. You want to repair, you want to replace some rugs that are wearing out. You need a new computer. Stuff that will impact the quality of your program. Then it makes sense, and it's fine to do that. But you're getting a lot of money, a lot of money. And this is not the time to say, wow, I should go out and buy stuff because I got all this money. And I need a new mink coat. And I need to, go to Hawaii for 3 weeks. Well, just be aware that you're going to owe some taxes on this money. And it's a better idea, in my opinion, to improve the financial circumstances of your family if you don't absolutely need it to improve the quality of your program. What do I mean by that? Have you been saving enough for your retirement? Do you have an emergency fund? Are you not paying off your credit cards in full at the end of each month? Do you still have a car loan payment? Do you still have student loans? All of those things, in my view, are better use of the money than buying more clothing for yourself or just opening up a catalog of toys and looking I want more toys because I can buy more toys without really needing it. Okay? So I hope that's clear. Tax-wise, financially speaking, it's better to pay yourself because you'll have more money left over than you will buying stuff for your business. Question. I will have 2 children in college next year. If I only use the money for business expenses, will this change my tax bracket, meaning affect my financial aid? Okay, if you use all of this money, $15,000, you use all of it to buy stuff for your business that you can deduct all of it. So you've wiped out all that income. So your tax return doesn't really look any different than before you got the stabilization money, because you're not showing higher profit, and therefore will have no effect on financial aid because you're wiping out all the income. If instead you took the 15,000 whatever number and paid it all to yourself and did not buy business stuff with it, your taxable income goes up by 15,000. Could that then affect financial aid with these colleges? It might. Therefore, what you want to do is contact the college and say, you know, assuming you're financially eligible now for this financial aid, how much more money would I have to earn before I would lose this financial aid, to make sure you stay under that? Now, maybe you can earn an additional 5,000 a year. I don't know. Then you only wanted to accept 5,000 from the stabilization grant to keep you under that, to make you continue to be eligible for college financial aid. So that's the answer to that question. So I want to pause here. If anybody wants to unmute themselves, I'm happy to talk more about what these stabilization grants mean.
I have a question, Tom, based on what you had just said about the college students. This is Karen Walsh again from the Child Care Council. We haven't heard that you can only accept part of the money. It's either an all or none thing.
Okay. Well, all right. Are they going to tell you soon whether or not you can do that?
I'm pretty sure they're not. They're telling us that providers have to accept it all, and they've given us no way for a provider to say, I only want half of it or a portion of it, or I only want 2 payments or anything. It's all or nothing.
So they can't return it?
As far as I know.
Okay, well, then,
any different?
So that, I'm glad you said that. So I guess I assume you could accept less, but if they say no, you got to take it all. Okay, so again, that means you should check this out with your college before deciding to turn in an application for the stabilization grant.
Yeah, this is Kathleen. I just want to verify that they cannot just accept part of it. They have to accept all of it.
Okay. All right. Well, normally we'd say terrific. More money is better than no money, but I get it. If it's going to hurt you, it's going to be more painful for you to lose the financial aid then you don't want this stabilization grant. But find out.
Would another option possibly be to find out what will put you over, pay yourself enough to keep you under, and use the rest on completely business-related items?
Yes. Yes. Either that's a unique situation where you've got a ton of money, and now what? Make sure you're under the gap and spend everything else on stuff for your business. Now is the time to open up a toy catalog and to say, hey, let's go crazy here. Let's install, a fantastic playground set in the backyard. Let's put up another fence. Let's add a deck. Let's do whatever we need to do to write this stuff off. Yes. Yes. All right. Okay. Anybody else here? Stabilization, other than what we just said, for everybody else, stabilization grants are a great thing. You should not be concerned that it might increase your taxes a little bit. And somebody had a previous question about setting aside money for taxes. So any amount of money that you are paying yourself for is going to be subject to tax. And how much tax should you anticipate paying on this? Roughly speaking, 20 to 30% roughly. It depends on your family's financial situation and how many children of your own you have, and what other tax credits are you getting, and other medical expenses, other personal situations can cause this amount to vary. 20 to 30% of the money that's not being spent on your business and is paying yourself should be set aside for taxes. Now, the next estimated tax payment is due January 15th. If you're filing estimated taxes earlier this year. And so then you can just add it on to that estimated tax payment due in January. If you don't file estimated taxes, you could have your spouse have more withheld from his or her paycheck between now and the end of the year. Although there's not that many pay periods until the end of the year, but you could just tack on, 20% comes out to be $3,000. You can just say, all right, tack on enough 3,000 divided by how many pay periods are left in the year, and add that, tell the employer to withhold that extra amount. As long as you're paying in 90% of the taxes you owe throughout the year, there's not a penalty. And another way to avoid a penalty is to look back at your 2000 tax return and look at the total amount of tax you paid in the year. As long as you have that amount plus $1 at least more withheld this year, there's no penalty. You may owe a bunch of taxes at the end of the year, but there's no penalty. All right? Anybody else here? Okay. All right. I'm going to move on. Expenses. If we were all in a room together, I'd say, all right, how many people here love record keeping? If you love record keeping, raise your hand. Well, one person might, and that person's probably in the wrong room. It's like most people do not love record keeping. You love caring for children. You don't, at the end of the day, you don't say, hey, now's the time for us to sit down at our desks and let's do some record keeping. I'm so excited. No, but there's only a couple ways you could make more money at what you're doing. You could care for more children if the state allows it, but that's not so easy. You could raise your rates, yeah, but that's not so easy. Or you could reduce your taxes. And in my experience, when I look at providers' tax returns after they're being audited, I can say almost in every situation, it was because the provider did not deduct everything they were entitled to and did not keep the records to show that. So most providers are paying too much in tax. Keeping good records means you're going to pay less in taxes. How much less? How valuable is this record keeping? Well, for every $10 of an expense that you might have, you're going to save about $3 to $4 in your taxes. Well, how does that come about? Income minus expenses equals your profit. You're going to pay about 15% Social Security tax on your profit, 12 to 21% or so federal income tax, and 4 to 9% or so New York state income tax. And when you add that together, most people are paying taxes at a rate between 30 and 40% of their profit, which is very high. The good news is that every deduction that you report will significantly lower your taxes. So you've just come home after spending $100 on some children's furniture or equipment that's only going to be used in your business. But when you unpack it, you realize the receipt's not there. You say, what happened to it? Oh, I probably left it in the car, so it probably fell off in the car. Is it worth your time and energy to go to the car, look underneath the seat till you find that $100 receipt, and then put that as a deduction on your taxes? If you do, it's going to save you $30 to $40. It's like paying yourself $30 to $40 for that effort to dig out the receipt. This is that simple. You're going to earn more per hour earning more per hour keeping records than you're earning per hour caring for children. Do you have to do all this record keeping stuff that I'm going to describe? No. Let's say your income for this year is $70,000. I have no idea. Well, can you say, Tom tells me to keep records. It's a pain in the neck. I'm not going to do it. I'm just going to put down my income, $70,000, and not claim any expenses at all. Can you do that? Yes. If you do that, are you going to get a call from the IRS? And are they going to say to you over the phone, what is your problem? You didn't claim any expenses. We know you must have some expenses, and you're paying too much in taxes. And that's really bothering us down at the IRS office. No, that's not going to happen. Are your friends going to get an intervention and tell you what is your problem? Why are you paying too much in taxes? We're all concerned for you. No, it's up to you. But there's a huge reward for doing this stuff. You got to keep your business records for at least 3 years. Now, for the stabilization grant, you need to keep your records for 5 years. 5 years in New York. Even though for the IRS purposes and the state tax return purposes, you only need them for 3 years. But might as well just save everything for 5 years. Now remember, if you're paying yourself, just that note that you wrote showing the transfer, the cancel check or whatever, that's all you need, so just keep that for 5 years. The IRS can audit you back 3 years. So they can audit you right now, 2020, 2019, 2018. They can't go back further than 2018 unless you didn't file a tax return, you committed fraud, or you significantly underreported your income. You can amend your return back 3 years and fix any mistakes, including claiming additional deductions that you should have claimed but didn't, and then get a refund. To do this, you got to fill out IRS Form 1040X, which is pretty straightforward. And if you do this, it will not increase your chances of being audited. So don't hesitate to correct mistakes. It does not raise any kind of red flag. All right. Well, what can you deduct in general here? You can deduct any expense as long as it's ordinary and necessary for your business. Ordinary and necessary means typical, helpful, appropriate, useful, common in your business. What is your business? It's providing a home learning environment for children. Parents expect you to maintain your home as a home. So virtually anything that helps clean, repair, or maintain your home is going to be considered ordinary and necessary. So burning tires on your front lawn is not good for business. Licensing rules require you to have a safe place for kids to play outside. So what expenses might you be able to deduct on the outside of your home? Well, lawnmower, gas for lawnmower, repairing a lawnmower, paying somebody to mow your lawn, snow shovel, snow blower, paying somebody to plow your driveway, planting a tree, taking down a tree, sod, fertilizer, trees, flowers, shrubs, stepping stones to get to the front door, the welcome mat, the doorbell, the batteries for the doorbell, the street sign, repairing your chimney, replacing your gutters, repairing your garage door, painting your outside of your house, putting on new siding on your house, and so on. When parents and children walk into your home, now we can deduct almost everything inside your home. Playroom, virtually everything in the playroom. What else? Outdoors, a rake, a fence, patio furniture, garden hose, a wheelbarrow. Living room, are kids in the living room? Are parents in the living room? If so, curtains, shades, blinds, chairs, lamps, ceiling fans, couch, end table, screen in front of the fireplace. Everything in the bathroom. Garage, virtually everything in the garage or the basement. Tools, freezer, storage shelves, everything, everything. One provider got audited. I always ask when I help people who are being audited, did you claim everything you were entitled to? And the answer I get is always no. And I say, well, why not? Well, I was afraid if we claimed these expenses, we'd get audited. And then I say, well, that didn't work. So what didn't you claim? And this one provider said, well, that was the year we bought a whole bunch of electric tools, electric saw, drills, planes, hammers, all kinds of stuff. Her husband was making cubbies for the kids. Her husband was making wooden toys for the kids. I said, do you have the receipts for these things? Yes. So I went to the audit and I said, we forgot to claim hundreds of dollars worth of tools. And we want to claim part of these as business expenses. And they were accepted. So in my opinion, it's best to get into the habit of saving receipts for everything, everything, rather than wondering when you buy something, oh, is this deductible or not? I'm not sure. I'm not. Just save it all. Just save it all. Why? Because there might be some things that you don't recognize are business expenses when you buy them. For example, let's say last February, you bought a toy for your son and he brought the toy into his room and never shared it with the children. Well, it's personal, you can't deduct it. But later this month, he takes the toy out of his room and lets the kids play with it. Now you can claim part of the cost of that toy. Did you save the receipt from last February? Maybe not, maybe not. It's easier to think about what's not deductible. What's not deductible are personal things, your clothes, except for scrubs, that would be deductible. But otherwise, your clothes, no. Now you might have on a sweater or a shirt that says, childcare is my business, daycare is great. That's advertising. That's deduction that way. But you can't deduct your shoes or your hairspray or your fingernail polish or the personal books you read at night or your motorcycle. No. If children sleep on your bed, you can deduct the blankets, the sheets, the pillowcase, the pillow, the rug on the floor to get to the bed. But if kids do not sleep on your bed, you can't deduct any of that. We also can deduct thousands of dollars worth of house-related expenses. Property tax, mortgage interest, rent, all kinds of utilities, gas, electricity, water, sewer, cable TV, wood, propane, gas, solar panels. My wife and I put solar panels on our roof last year. If we were a childcare provider, we could deduct part of the cost of that. House insurance, house repairs, house depreciation, thousands and thousands of dollars. You can deduct these things. To deduct something, you have to have an adequate record. Now, you're not required to have a receipt. You want to have a receipt. That is the best adequate record. But if you don't, what else might you have? A canceled check or a debit or credit card statement? Well, not as good as a receipt. You went to Walmart, you spent $50, but you lost the receipt. Now what? Well, your record shows on a monthly credit card statement, Walmart, $50, but it doesn't say in there what it was. So what was it? Was it baby wipes or shotgun shells? We don't know. So that's the time you want to make your own written record. You want to realize, uh-oh, all I have is a canceled check. All I have is a credit card statement. I need to make a note. Okay, that was July 3rd. When I went to Walmart and spent 50 bucks, those are baby wipes and toys and cleaning supplies, whatever. And you write out a note. And if you still have the item, take a picture of it. For everything that you have bought so far this year that you don't have a receipt for, go back, make out notes to the best of your ability. You might be guessing. You don't remember exactly where you bought it or exactly how much it cost. You're guessing. You're doing your best, and take pictures of these things. And you'll be okay. And you can then deduct it. You're going to garage sales, eBay, you're not getting receipts. So you make a note. August 1st, garage sale, Smith Avenue, used high chair, paid $10 cash. And then take a picture of that high chair, and you're good to go. You're not required to have a receipt, but going forward, every time you can possibly get one, you want to get it and keep it. Now, there are extra expenses I'm sure you have because of COVID. And any of these things you can deduct. Gloves, masks, disinfectants, thermometers, sanitizers, room dividers, face shields. You pay somebody to come in and do deep cleaning in your home. Food deliveries. You didn't want to go outside the home as much earlier this year, so you paid to have food delivered or anything else delivered. One provider said, if I tip the food delivery person, can I deduct the tip? Yes. Are you spending money on curriculum or activity expenses because you're doing distance learning and it involves you spending more money on some stuff? If you're closed for any period of time and you decided to take the opportunity to paint or construct stuff, put up a wall, remodel, or whatever, you can deduct those expenses. One provider did not want parents to drop off or pick up their children in her home. So she had them do that in her garage. But then she said, I needed to insulate the garage and put in a space heater there. She can deduct that. Another provider bought a ventilation system for the rooms that the children were in to help reduce the spread of COVID. She can deduct that. So keep receipts for all of this. What about larger expenses? There's been some significant changes over the last 3 to 5 years in this area. And with 3 exceptions, the rule now is you can deduct the business portion of any item in 1 year, regardless of its cost. So, $5,000 fence, $6,000 worth of furniture and appliances, $2,000 swing set, $8,000 patio. You can always deduct those items in 1 year. The 3 exceptions are a house, a home improvement, and a home addition. For all these 3, you must depreciate them over 39 years. But it's important to make a distinction between a repair and a home improvement. A repair you can deduct in 1 year. A home improvement you have to depreciate over 39 years. So, wow, that's a big difference. What is a repair? A repair would be painting, wallpapering, fixing things that break, replacing less than half of your windows, less than half of your floors, less than half of your doors, putting on just new countertops in your kitchen. Those are all repairs. An improvement would be replacing more than half of your windows, floors, or doors, remodeling your entire kitchen, countertops, cabinets, appliances, flooring. That's an improvement. Buying a furnace, building a deck, those are improvements. So you just need to know the difference. With the house, You must always depreciate the house. The rules have not changed for the house. So do not let anybody tell you that you shouldn't depreciate their house. Because if somebody says that to you, they're wrong and you should run away from them. Why? Let's say you're claiming $1,000 worth of depreciation on your home every year. I'm just making that number up. After 10 years, you've claimed $10,000 of depreciation. This helps significantly to reduce your taxes over 10 years. But then you go out of business. And 1, 2, 3, 5, 10 years later, you sell your home. Whenever you sell your home, you will owe tax on the depreciation you've been claiming in your home. In this case, $10,000. You'll owe taxes on the $10,000. If you didn't claim the depreciation, you would still owe the taxes on the $10,000 because the IRS rule clearly states that you will owe taxes on items you sell even if you didn't actually claim the depreciation because you were entitled to. So by not claiming the depreciation, you are just losing all these deductions, and it will not reduce any taxes that you would owe later. So somebody telling you not to depreciate your home does not have a clue about how this works. Somebody asked a question about a roof, and a roof is, it's a little iffy. It's a gray area. One way to, because I've heard different things from different tax people. One way to look at a roof is you're just replacing the shingles, let's say. And that's not the roof. The roof is really the underneath. The shingles are just to keep the water away from the roof. And if you look at it that way, just replacing shingles, that could be considered a repair. Clearly, if you're replacing the boards underneath the shingles, that's a new roof, that's an improvement. If you replace shingles with tile, then that would be an improvement. That's an upgrade of your roof. So I would probably side on, if you're just replacing shingles, treat it as a repair. Somebody says, I put in a pool, can I deduct that? Yes, a pool would not be considered a major home improvement because it's attached to the land, and therefore you can deduct the business portion of the pool in 1 year. All right. Now, so far, I've just been saying, deduct it, deduct it, deduct it. Go for it, go crazy. But we need to now answer the question, how much of these things can you deduct? So, if you buy something that's used exclusively personal use, obviously you can't deduct it. Your meditation tapes to get you calmed down at the end of the day, no. Your membership in a gym to keep yourself physically fit so you can do childcare, and no, unfortunately not. Dogs and cats are considered by the IRS strictly personal, no matter what you're doing with them, with the kids. If something is used exclusively for your business, well, then logically you can deduct 100% of that. Exclusive use means never, ever, ever used personally. And so you buy a rocking chair that's in the kids area, but you like it so much that on evenings you go down and sit in the rocking chair, then no, it's not exclusively business. It's not why you buy something that's important. It's how you use it. So if you're buying the rocking chair thinking to yourself, the only reason I'm buying this rocking chair is because I have babies I want to rock. If I wasn't in business, I would not be buying a rocking chair. Okay, but how do you use it? You would have to say, I never, ever, ever use it personally to be able to deduct 100% of it. And providers sometimes make this mistake in deducting something as 100% and not realizing that they're also using it personally, and that makes it impossible to deduct 100%. If you're buying something as business and personal use, you can deduct the business portion of it. And the typical way to claim this is applying what we're going to call our time and space percent. Now, let's say your time space is 30%. Let's say you buy a swing set for $3,000, whole jungle gym thing outside for $3,000. And you've got 6, 7, 8 daycare kids and only one of your own. And your child does use this swing set on evenings and weekends. So it's not 100% business, but it's clearly more than 30% business. If that's the case, you can always calculate an actual business use percent. What is the actual use of this swing set? Well, you'd have to track it for a month or two. How many hours of business use? How many hours for personal use? 79%. If you track it, have some records to show how you came up with your actual business use percent, then you can claim whatever, 79% of the swing set, and then use your time space for everything else. It only makes sense to use an actual percentage if the difference between the actual use and the time space is large, and we're talking at least hundreds and hundreds of dollars worth of an item. Question, can you deduct a cell phone? Well, only if it's not the first line into your home. In other words, if you only have the cell phone and no other landline and no other cell phone, you can't deduct it because you only got one line and you can't deduct the first line. If you have another cell phone or a landline plus your cell phone, then you can say one of those other lines is the first line, the landline. You can't deduct that. But now you can deduct the business portion, the time space percent of your cell phone that you use in your business. All right. What is the time space percentage? It's the formula that we're going to use to determine how much of your shared expenses you can deduct. And you have many shared expenses: property tax, mortgage interest, rent, so on, furniture, appliances, supplies, household items, everything, all these shared things, bedding, towels, cleaning supplies, laundry detergent, on and on and on. Thousands and thousands of dollars worth of stuff. The higher your time space percentage, the bigger your deductions and the lower your taxes. It's based on a time percent, the number of hours you're using your home for your business, and a space percent, the number of square feet you use on a regular basis in your home. We multiply these two percentages together to get what's called your time space percentage. You're going to enter information about space and hours into IRS Form 8829, expenses for business use of your home. If you're doing childcare in your home, you always must fill out this form. If you're doing childcare away from your home, in a church or another home, you don't use this form. The time percent includes the hours children are present from the moment the first child arrives until the last child leaves, plus all the hours you're doing activities in your home for your business and children are not present. The space percent is the number of square feet you're using in your home on a regular basis. You look at each room and you say to yourself, am I using this room on a regular basis in my business? If you are using it 2 or 3 times a week for some business activity, then that's considered regular use. Children take a nap on your bed every other day for 10 minutes a day. That's regular use. Children don't go into your bedroom, but maybe you have a computer, a desk, a file cabinet. You're storing children's stuff in your bedroom. Then your bedroom is regularly used, even if children are never in there. you must count the basement and the garage as part of the total square feet of your home. Now, in most cases, you'd be able to say that those two areas are also regular use in your business. What do you got in your basement? Furnace area, hot water heater, tool bench, extra refrigerator, freezer, storage stuff, Christmas ornaments, bicycles, other stuff. That's regular use. Your garage, you got cars, garbage can, recycling bin, bicycle, lawnmower, paint cans, outdoor toys, regular use. It's not unusual to have a space percent of 100%. Now, COVID, 2021. Were you closed for any period of time because of COVID? If you were, or you're caring for more part-time kids and weren't clocking as many hours when kids were there, this is going to lower your time percent. It'll lower your time and space percent. It will increase your taxes. So we need to pay closer attention to what we can do to offset this negative impact. What you want to do is to make sure you've captured all the hours you're doing some kind of business activity in your home when children were not there. Now, before COVID, I would always talk about the fact that it's important to track these hours. All right, so you're cleaning a half hour before the kids arrive in the morning and cleaning a half hour after they leave. Meal preparation, activity preparation, record keeping, and so on. It's always been the case that you could count those hours. But now it's even more important to count those hours as well as any other hours that are directly related to COVID. Now you're cleaning not a half hour in the morning and the afternoon. It's maybe an hour in the morning, maybe an hour in the afternoon. You're doing a lot more cleaning, I presume. Maybe you've been doing distance learning. Maybe you're talking more to parents or children on the phone, or talking to licensing, or on hold at the unemployment office, or preparing activities, or doing more record keeping, attending other Zoom meetings, spending more time on the internet, on Facebook, reading books that have to do with childcare when kids are not there, taking a CDA class, taking any kind of class, listening to me now. If you're in your home and daycare children are not there right now, you can count the 2 hours as part of this class. So as soon as we're done, you should take out a calendar, go into kid care and put 2 hours, stabilization grant, taxes, Tom Copeland, Zoom meeting. That's it. You got 2 hours. Now, have you been tracking these hours so far this year when kids are not there? In an ideal world, you'd be carefully tracking these hours for at least 2 months each year, and then use the average of those 2 months for the rest of the year. We're in the last 2 months of the year. So you could start now carefully tracking your hours in November, December. And if you can say that the hours you worked this month, these 2 months, were typical of the hours you used your home for business previously, then count those same number of hours for each month. In other words, if you work an extra 40 hours in November and 44 hours in December, the average is 42. If the rest of the months are similar, use 42 hours for all 12 months of the year. This is significant. Now, what else could you do? You could go back and try to reconstruct as much as possible. What were you doing? Did you have a regular cleaning schedule for all these months so far that was more than your normal cleaning? Then write it down. Write down what you do every morning and every evening. And go back in the calendar and start making notations of when you did that work. This is a pain in the neck, I agree, but this is the single most important thing you can do to reduce your taxes is to come up with an accurate number of all these extra hours. Some providers have said to me, Tom, I'm working more hours this year than I was last year, simply because, you know, kids are still here and I'm spending all these extra cleaning hours, etc. Another thing that could help offset some of these lost hours would be to pay more attention to when the first child arrives and the last child leaves, particularly when the last child leaves. It's not important when the parent signed out or what it says in your contract. We want to know when that last parent actually leaves your property. Pickup time is 6, but the last parent's not showing up until 6, and then it's staying longer talking to you. You want to know when they finally walk out. An extra half hour a day is equal to about 3% of the year, which doesn't sound like a lot, but we're multiplying this by thousands and thousands of dollars of expenses. So it is significant. In 2022 and every year after that, you want to carefully track hours for at least 2 months a year. And I'm willing to bet if you haven't done this before and you carefully track this for 2 months, that you'll come up with a number that's higher, more hours than you've been previously putting on your tax return. Because most providers just simply greatly underestimate how much time they're spending on their business. Now, you can't count time away from your home, even if what you're doing is related to your business. Going to the bank to deposit money, going to the library to get children's books, clearly business trips, but you can't count the time because you're away from your home. You can't count time twice. So kids are sleeping and now you're doing some record keeping while they're sleeping. The record keeping time doesn't count. He's already counted that time. You don't have to be the one doing the work to count the time. Your husband gets up Saturday morning and cleans up after the kids for an hour. You can count the hour. You and your husband clean together for an hour. Still 1 hour. Clock went around just once. But if you clean for an hour and then watch him clean for an hour, now you got 2 hours. Don't work together. Questions about the time and space percentage? Everybody's excited. Okay, vehicle expenses. You want to keep track of business miles because this represents a substantial deduction. You can claim a trip as a business trip as long as it's primarily for business purposes. That means more than half of the reason for the trip was business. Going to the bank, going to the library, clearly business trips. Going to Costco to buy more business food than personal food, business. But you shouldn't be claiming every single trip to a grocery store as a business trip. Even if you're spending more money on business food than personal food every time you go. The IRS is just going to say, you got to have some personal grocery store trips. So don't claim them all. In order to claim these trips, you need an adequate record. And you've got lots of different adequate records. Maybe you have a receipt, mileage log, canceled check says you were there, debit or credit card statement, a written record that you wrote out, calendar notations. You mark on your calendar park, school, library. That's it. That's the only record you need. Photographs. Here we are in the park, April 10th. This picture says we were at the park. We can count the trip to the park. You don't need to keep odometer readings for any of this. You just need to know how far they are. So the library is 6 miles, the bank is 2 miles, whatever. Now, there are a number of mileage apps that you could use that will make this a lot easier. And if you go to my website and search mileage apps, you'll see an article where I identify 4 or 5 different apps that you can go to. The one I'm familiar with is Mile IQ. Costs $6 or $7, somewhere in there, a month. You download the app. You get in the car with the phone. You drive. The end of the day, the end of the week, the end of the month, you open up the app and it'll tell you all the trips you took that week, day, or month. And then you'll select which ones are business trips. And after you've done that, it will add up all the miles for those trips and multiply it by the standard mileage rate, which tells you what you can deduct. You never look at the odometer reading. You never have to worry about forgetting to write down where you went, or you never have to know to begin with how far the bank is, because the mileage app will tell you. You can deduct 100% of the cost of the mileage app. And lastly, imagine going Saturday to garage sales and you're driving, 3 or 4 different places, and then you come home. And then you forget to note what the odometer reading said at the beginning and ending. And you could not even reconstruct where you went all over the place. And so you've kind of lost that trip. But the mileage app will tell you how far that trip was. Pretty cool. In claiming expenses for the car, you can use one of 2 methods. First, the standard mileage method. And for this year, it's 56 cents a mile. I can probably promise that it's going to be higher next year. If you use this method, you can also deduct parking, tolls, the business portion of car loan interest, and the tax you pay each year when you put the new sticker onto your license plate. It might be called an excise tax. But when you look at your vehicle registration every year that you're paying, look for the word tax, and you can claim the business portion of that. Well, what is the business portion? The business portion is the number of business miles you drove in the year divided by the total number of miles you drove. So for example, if you drove 2,000 business miles and 10,000 total miles, that's 20%. And then you could get 20% of all the actual expenses, gas, oil, repairs. Somebody's asking about this, vehicle repairs, yes, car insurance, parking tolls, depreciation on the car loan interest, ice scrapers, jumper cables, new tires, repairing a broken fender, everything. Just save receipts for everything and multiply it by your particular percentage. Most people use the standard method because it's easier. You don't need receipts for everything. But there are providers who would be better off using the actual method, particularly if you bought a car this year. Then you're much more likely to come out better using this method. All right? Let me pause again. Anybody want to jump in? All right. Food program. I hope everybody is on the food program. I hope you all understand that you're always financially better off being on the food program. It's like getting a grant. It's like the parents paying you more money. It's like winning the lottery. Getting more income means your taxes are going to go up because money from the food program is taxable income. But you're always going to have more money left over after you pay the taxes on this money. If you're getting reimbursed reimbursements for your own children, that's not considered income. But any food that your own children eat is also not a deduction. And any food that you eat at home is not a deduction. If you have employees and they're eating with the kids or eating while they're caring for kids, you can deduct that food. Everybody's getting the higher tier 1 reimbursement rate until next July. And then who knows what will happen then. But getting more money now because you're on tier 1 rather than the lower tier 2 is a good thing. You're going to pay a little more in taxes, but you're still going to have more money left over. A food program is for both homes and childcare centers. If you're a family childcare provider, you're always eligible to get on the food program. If you're a childcare center, you may or may not be eligible. You must be serving a certain percentage of low-income children to be eligible for the food program as a childcare center. Talk to your local childcare resource and referral agency. They can connect you with a food program sponsor that can help you understand whether or not you qualify. If you do qualify, get on it. It's money. It's somebody giving you more money. When that happens, you say, I'll take it. All right, there's 2 ways to claim food expenses. The first is called the standard meal allowance method. Using this method, you do not need to save food receipts. At the end of the year, you're adding up all the meals and snacks you served and multiply it by the annual standard meal allowance rate. And here are the rates for last year and this year. And notice the huge increase between 2020 and 2021, the biggest single increase in decades. So for this year, $1.39 for a breakfast, $2.61 for a lunch or a supper, 78 cents for a snack. The food program will reimburse you for 3 servings a day. You can deduct up to 6, 1 breakfast, 1 lunch, 1 supper, and 3 snacks per day per child if you serve that many. If you're serving an extra snack, it does not have to be nutritious. You're not getting reimbursed for the meal or snack. It does not have to meet any nutritional standards. So you're on the food program, you're serving breakfast, morning snack, lunch. Get reimbursed for that, great. But now you serve an afternoon snack at 2 p.m. What are you serving? Popsicle, candy bar, ice cream, potato chips, whatever. I'm not telling you to serve junk food. I'm just saying whatever you do serve is deductible. So, who wants a popsicle? No, I don't want a popsicle. You're going to have a popsicle because I can deduct 78 cents for this thing. Take the popsicle. One provider said, as children leave at the end of the day and they're walking out the door, she passes out 1 cracker. 78 cents, 78 cents, 78 cents, 78 cents. She is making money passing out crackers. How valuable is it for you to report and deduct these extra snacks? 1 snack a day for 1 child for a year is a $202 deduction. Now you serve a 4 p.m. snack. You got 2 extra snacks. That's $404 per child per year that you can deduct and reduce your taxes by significantly. In order to do this, you need to have a daily record of how many meals and snacks each child ate. Now, when you're on the food program, your monthly claim form is the only record you need for that. But now we're talking about unreimbursed meals and snacks. Now what? If you're using the Kid Care software program, you can put up to 6 servings into the software and it will tell you what you can deduct. Kid Care won't allow you to put in a non-nutritious snack because you got to use the pull down menu and find something on that list to call a snack. And there's no Doritos on that list. So what are you going to do? You pick something that is on the list. And it doesn't matter what you pick. Banana. I like bananas. So it's banana, banana, banana. the end of the year, you got 10,000 bananas. That's okay. As long as your food program sponsor realizes you're not trying to claim that, because it's more than the 3 servings, then they shouldn't care. The IRS doesn't care because they can't even ask what you served. The only record you need is an attendance record. Sally was there on Monday, and how many additional meals and snacks did she get? And you just put S for a snack. That's 1 snack. Or PS, PM snack. That's it. If you haven't been tracking all these extra snacks that you served up until now, it's well worth your time to take out your attendance records and reconstruct. If you always serve an afternoon snack, always, then if that child was there in the afternoon, you know that she got a snack. So looking at attendance records, how many days was she here in January? 15, February, 10, March, 20, whatever. Add them all up. Start doing a daily record now, starting tomorrow. And this is a lot of money. This is a significant amount of money. Now, there is a second way. If you don't like the standard meal allowance because you feel like it's too low, that your cost of food is really higher. And with the jump in price of food lately, that may well be more true for more providers. So what are you going to do? You could estimate your actual food costs. And there are different ways to do it. My record keeping guide lists about 5, 6 different ways. You can buy food separately. You can calculate your own average cost per breakfast, lunch, and snack. You can calculate a percentage of the total amount of food. But in all cases, you would need to save business food receipts and personal food receipts, because without that, you would have some trouble in an audit. So if you haven't been saving them all this year, you could start saving everything next year just to see which method comes out better for you. So now let me say something about Social Security. Why am I talking
Tom?
about? Yeah.
Before you move on, I just want to remind everybody, if you're interested in the food program, to give Lorraine a call at the Child Care Council. She's there to help you get on the food program. And
Right.
I also remind everybody, please take advantage of the fact that we have Tom on the line. And if you do have your questions, now is the time to take advantage and ask those questions when he opens the floor for you. Thank you, Tom.
Good. All right. Yes, get on the food program. All right. The reason I'm talking about Social Security is this. Because we're still in the middle of this pandemic, and for many providers, financial difficulties. I mean, these stabilization grants are, wow, this is a lot of money. This is fantastic. But still, maybe I've always had a plan on when you're going to start claiming Social Security. But now you realize I might be able to claim Social Security earlier because I need the money now. And so before you make a decision about Social Security, I strongly recommend that you take a little time to understand the consequences of your decision. So let's explain a little bit about Social Security. You can start claiming Social Security as early as age 62. Your full retirement age is either age 66 or 67, depending on when you were born. And maybe you're older than 62, but under your full retirement age, and you're still working. If you earn more than $18,960 profit this year and claim Social Security before your full retirement age, you're going to get a little bit less. The benefit's going to be reduced by a little bit. Now, once you do reach your full retirement age, Social Security will start paying you back this lost benefit, but it'll take a number of years before you get fully back to normal. So, when should you claim Social Security? Well, ideally, until at least your full retirement age or at age 70. Age 70 is the last year you can claim Social Security. Any money that you earn after your full retirement age, it doesn't matter how much you earn, your benefit will not be reduced. Now, every year you wait after age 62 to claim Social Security, your benefit goes up a little bit. So there's an incentive to keep waiting if you can. And if you wait until 70, the last several years of Social Security, your benefits will go up by about 8% a year. Those last 2-3 years. That's a lot. So that's why we say, gee, try to put it off for as long as you can. Now, maybe you can't wait that long. Okay. Maybe you got bad health or you just have financial crisis now and you just need that Social Security now. I understand. But I am saying before you make that decision, understand what it means. And here's what I'm talking about. First, you want to go to the Social Security website, socialsecurity.gov. And if you haven't already created your own account, it's simple to do. And then you'll see your annual Social Security statement. And your statement will say how much you can expect to get from Social Security at age 62, full retirement age, or age 70. So you can see for yourself how much more you're going to get if you wait. Your Social Security benefit is based on the highest 35 years of earnings over your life. And it'll show you for every year that you ever worked how much money you made. And if there's a blank number 0 at 2010, and you were either doing childcare or doing something else and earning money, whoops, there should be a number there. And if it's a 0, that could slightly lower your benefit. So you need to check that out and contact Social Security to find out what was the problem. The amount on your Social Security statement that says how much you'll earn at age 62 and so on is based on the assumption that the amount of profit you made last year is going to be the same each year until you reach age 62, full retirement age, and age 70. So if you anticipate that your income is going to be going up between now and then, your benefit will go up. If it's going to go down between now and then, your benefit's going to go down a little. So you can keep checking back each year to see how those numbers fluctuate, up or down. Most likely up. It'll also tell you whether or not you currently qualify to get Social Security. You must have paid into Social Security for at least 10 years. So if you've only been working, earning money for 9 years, and you quit this year, you're not going to get anything from Social Security. So you look for that on your statement. Yes, you currently qualify to receive Social Security. No, you need a few more credits, a few more months you got to work before you're going to be eligible to get the benefit to begin with. Now, the second thing you want to do is go to this website, opensocialsecurity.com. It's a free online calculator that will tell you when to claim Social Security to get the maximum Social Security benefit over the course of your life and your spouse's life. You'll plug in your age, got a spouse, his age, how much you can expect to get from Social Security at your full retirement age. So you need to take step 1 first. And then it'll tell you the month and the year each of you should start claiming Social Security to get the most over the course of your life. Now, my wife is 4 years younger than me. Our plan was always, I would wait till I'm age 70, she would be age 66 at that time, then we would both start claiming Social Security then. We'd always thought that's what we should do. But when we put this into the calculator a few years ago, it said, no, your wife should claim Social Security earlier than age 60, than her full retirement age, 66. And at that time, I was entitled to claim half of her benefit until I got to be age 70, and then I would get my full benefit. In other words, I wouldn't lose anything by claiming earlier with my wife. She would earn a little bit less in Social Security benefits because she's getting it before age 66. But that lower benefit to her is more than offset by a much higher benefit from me. Now, I thought I knew something about Social Security. I didn't. I cannot explain to you why that happened. I went to a financial planner. I said, look, this calculator says we should do this. Does that make sense? Because I don't want to just rely on an online calculator. She said, yes, that's correct. Do it. And I want to be overly cautious. So my wife and I went downtown to speak face to face with somebody from Social Security. And I said, is this right? Can we do this? Yes, you can do it. So we signed up for that. I had no idea. I can't explain to you why. I don't know if that works in your situation. Social Security is complicated. Maybe you're divorced. It matters whether or not you've been married for at least 10 years. Maybe you're a widow and that affects it. Maybe you or your own child has a disability, that affects it. So I just got to tell you, before you think about claiming Social Security, can't highly recommend enough taking these 2 steps. Now, you still may want to make a decision other than what this calculator tells you because of your own personal circumstances. Okay, but most people don't understand Social Security, and I think this calculator is a great educational tool. Questions about this? All right. Question, 35 years in a row or 35 highest selected from all possible years? The highest selected from all possible years, not 35 years in a row. Good heavens, that would be awful if that was the case. How does having a child who has a disability affect Social Security? You could get a disability, you could qualify for disability. Social Security is not just a retirement payout, it's also for disabled people. So you should go to that calculator. You should contact Social Security and find out what benefits you're entitled to because you have a child who has a disability. All right? It doesn't affect your Social Security or your spouse's Social Security. It's just a separate thing about disability. All right. SBA loans. Now, there's this Paycheck Protection Program, PPP, that many providers got money for. And it's not taxable income. And you have to apply for forgiveness so you don't have to return it. So the program ran out of money months and months ago. So now we're talking about forgiveness. You want to wait at least 11 weeks after you got the money, if you did get the money, before you apply for forgiveness, because that way you can say that you used all of the money to pay yourself. And you don't have to worry about the other rules because there's a much more limited kinds of things you could use this money for. And if you pay yourself with all of it, you don't have to worry about this at all. You would apply for forgiveness through your original lender. Some lenders are saying, we've decided that we want all our folks to apply for forgiveness directly through the SBA website. So that's another option, depending on what your lender says. I've written an article describing in detail how to fill out the forgiveness application form. And I think I've even done a little instructional video on this. So you should check that out. Now, there's another SBA program that's still alive called the Economic Injury Disaster Loan Program. It's a loan. You do have to pay it back. With the PPP money, you do not have to pay it back. So this is a loan, a true loan that you're paying, if you get it, 3.75% interest payable back over 30 years. And you can apply for this now. You can use it for just about any business expense, including paying yourself. And again, once you pay yourself with this loan, you can do whatever you want with it. Why would somebody want to do this loan after receiving so much money under the stabilization grant? Well, you may have had in mind doing a major project, adding an addition, some big thing that you've been planning on, and that the local bank would not offer you as good a deal as this, 3.75% over 30 years. So that might be a reason why you'd want this loan. But if the stabilization grant covers your needs, you don't need to worry about trying to get another loan. All right. All right. We've folks have put in the chat the link to my article about the PPP loan. You'll be getting a copy of the PowerPoint slides, and it's also being recorded. Now, we're still in the middle of this pandemic. It's not out of the question to think that there's going to be some future financial crisis before we all retire. You know, we have stock market crashes up and down. We got this pandemic. Maybe there's going to be another pandemic. Maybe there's just something else, a disaster down the road. So it may be hard to think about this now because you're not in the greatest financial situation right now. But if your circumstances stabilize and you're doing okay, then I would strongly recommend you take a little bit of time to think about what you can do to help reduce the financial impact of the next crisis. What am I talking about? Setting up at least a 3-month emergency fund. 3 months. That means, what are your bare bones expenses each month? What's the minimum you need to live on for 3 months? That's how much you want to have in a safe savings account. Now, imagine if you'd had a 3-month emergency fund when COVID first hit, life, I think, would have been a lot easier to deal with. My wife and I knew we should have an emergency fund, but for many, many years, we didn't do anything about it. We'd always get a refund, and we'd divide up the refund, and who knows where the money went. So finally, we got smart. We said, well, look, we're always getting tax refunds. We don't need the tax refund because we never planned on it. So we said, why don't we just put that into our emergency fund? And so that's what we did. And it's taken many, many years, but we finally have at least 3 months in that emergency fund. What else? So that means, you know, putting aside a little bit, 25 bucks a month, something, so that you start an emergency fund. Try to get into a habit of contributing to it on a regular basis, or just dump all the tax refunds. Or one provider says at the beginning of each year, she'll pick out a child and use some of that money for her emergency fund or the food program check, whatever. Claiming all business deductions is important, and use those tax savings to help fund the emergency fund. You could raise fees, registration fee. If you have these, you can just increase them. A registration fee, late pickup fee, early drop-off fee, supply fee, field trip fee. You're giving me a headache fee, whatever. Are you still spending money on COVID supplies? If so, in my opinion, you should pass on those costs to the parents. If you're spending $30 a month, I don't know, on COVID stuff, and you have 5 families, that's $6 a month for each family to pay you extra. Call it a COVID surcharge fee. A COVID surcharge fee. It'll go away. It's temporary, a temporary COVID surcharge fee. It'll go away when my expenses go away. And $6 is, other than subsidized parents, shouldn't be a big deal at all. $6 a month. And you know, it's a reasonable thing to do. And $6 a month is still what, $360 a year, something like that. And I think that's worth it. I think that's worth it. Reduce debt. One of the ways that people struggle during a financial crisis is having high overhead. You know, if you've got car loan interest you're paying interest on credit card debt, you have student loan debt, you have a home improvement loan debt. Well, you want to try to reduce those, particularly credit card, student loans, car loans. Those are the big 3 you want to try to eliminate as soon as you can, because then the next time there's a financial crisis, you don't need as much money to survive each month. Part-time care, school-age care. I've been hearing from child care programs around the country that parents are looking for smaller group sizes for their kids and for part-time care more now. Why? Parents are more likely to be working at home. Some parents only go into work 1 day a week or 1 week a month, and therefore they don't need as much full-time care. If you've not previously wanted to care for part-time kids, I can understand it's not so simple, but it's something you may want to consider when the next pandemic or the next crisis appears, because you can earn more money per hour caring for part-time kids than you can caring for full-time kids. Raising rates. Starting last July, all parents of young children, including yourself, are getting this advanced higher child tax credit. And it represents about $250 to $300 per month per child. And the parents in your program are getting an extra $250 to $300 per month because they have a child. If you raise your rates by $10 or $20 or $50 a month, the parents can afford it. Now, I wrote an article about this back in July, and some providers didn't like what I said because they felt like, you know, parents shouldn't have to pay anything more. Okay, this is all up to you. I'm just saying this is an opportunity. It's a reasonable time to raise your rates because of this new tax credit and because there are fewer providers now than there were a year ago. That's what I want to say. You want to properly report income, meaning grants. You want to claim all those business expenses. You want to carefully track those hours for at least 2 months. And you want to take a little time to learn a little bit more about Social Security before you decide to start claiming benefits. All right, question here, and we got a few more minutes for questions. Is Social Security calculated on your highest income? And what's the percentage? No, Social Security looks at your life history of each year, how much you've made. And they're looking at the highest 35 years of earnings. And further than that, I can't tell you exactly how the calculation comes out to be what you're going to get in benefits. Obviously, someone who earns more money than you is going to get more Social Security benefit than you. And you're going to get more of a benefit than those who earned less money from you, the less money. So I don't know what the percentage is. Whoop, there we go. Okay. we have a few more minutes. So post a question in chat or just unmute yourself.
Please, everybody, this is Karen from the Child Care Council. We've got about 17 minutes. Unmute yourselves and ask Tom a question. It's a great opportunity for you.
Everybody's excited. Too excited to talk to me.
Wonderful. That's my 2 cents worth. This is really amazing. Thank you so much.
You're welcome.
I've been peppering you with questions already.
Okay,
I
I have a question.
go ahead.
Calculating space ratios.
Yep.
I had my accountant do it, but it was difficult. We actually had to sit there and figure together because, let's say, you know, just for evens, just to make the number even, is 1,000 square feet. It's 5 days a week. It's 10 hours a day. And the percentage of the rooms in the house that is used is 100%. There isn't a room in the house that isn't used.
Yep, that's 30%.
He calculated 0.357.
Well, if you worked 50 hours a week.
Well, I gave you rough numbers, so it's a little bit different with what I actually am.
Okay, so then you're in the ballpark of accuracy.
So now with this loan, with this grant, I would take, saying that 30%, and I'm going to backtrack my mortgage. I've decided I'm going to do my mortgage. And I'm going to backtrack my mortgage to how far back I can go is 2020, January 2020.
Yeah.
And I would take 30% of that mortgage and use that as a deduction against the grant?
No. Well, that's a good question. Yes, you can go back to January 31st, 2020 to use grant money for those expenses.
Right.
But in 2020, you deducted the proper percentage of your mortgage. So now we're just talking about 2021 because you're not going to amend.
Oh, you know, you're talking about it has to be concurrent with the ratio that existed at that time.
Well, okay, let me simplify this a little bit. Let's say your time space percentage this year is 30%. Let's say your time space percentage last year was 35%. Let's just say you were entitled to 35% of the depreciation on your home and the mortgage loan interest. You don't amend that return. You don't get additional deductions for last year.
No, I know, but in order to justify receiving the grant that we got this year.
Right. So you would say, and I'll just make up numbers. Let's just say the amount of mortgage you were entitled to claim last year was $3,000. So then you could say $3,000 of this stabilization grant I'm using for 2020 mortgage. All right.
Right.
It does not create any additional deductions for you this year because it was an expense last year. So
however, if for audit purposes on the grant, though, you know, like for what I did was I created a spreadsheet. And on the spreadsheet, you know, I have categories. Of course, I have mortgage and I backdated the mortgage. And I just use basically the number that was calculated by my attorney, whether it's higher or lower. If I just put that, you know, yeah, I understand you could get more.
Well, okay. So here's the deal. Let's just say on your tax return in 2020, you were entitled to claim $3,000 for mortgage. Okay.
Okay.
So you would write out a note. You would save the receipts for those monthly mortgage payments. Okay. And you'd say the mortgage payment for the year was $6,000 times whatever it is, times my time space percentage equals $3,000 because you only get the time space. Yes, so that the $3,000 that represents the business portion of my mortgage in 2020, I can use with the stabilization grant money. Now, what does that mean? That is the same tax consequence as paying yourself,
Right.
because you can't deduct any of that on your current tax return. So that just means that $3,000 you're going to pay tax on this year, which is the same thing as paying yourself. So by saying I'm using it for mortgage back then, you have to take the extra step of keeping the receipts and doing the calculation.
So if I go into my mortgage,
I'm not done. And so if you want to do that additional work, you can, or you can just say that 3,000 is what I'm paying myself now. And once you do that, you don't have to account for it. You don't have to show receipts. You don't have to do any calculations. It's all your money. You're still going to pay tax on it, either way you do it. Does that make sense?
in the confusion for me is with this grant is what I showed to my tax accountant as a deduction this year and what I put in a spreadsheet in case I come under audit because of the grant, you know, because they're not the same.
Well, if you, option one, here I've saved all the receipts and shown how I've done the calculation for how much of this money went for 2020 mortgage expenses. That's option one.
Right.
Option two, here's a note that I made to myself that said this money was paying myself. Either way, in the end,
It shows on the
you're going to pay taxes on that.
I think the challenging thing for most providers at this point is it's very difficult to pay yourself. You guys deserve the payment. You deserve it. You work hard all year. You deserve to pay yourself.
So if you're using one general account, like I'm a family daycare.
Right.
So I've also listed myself as an S corporation. But I only use really one account because I tried to use two business accounts. Got very confusing. So I just decided to use one account, just easier for me. So if I wanted to show that I paid myself, would I be able to use like one of those receipt books and write myself out a receipt each week that this is for salary, this is for salary, this is for salary, and keep it along with my receipt?
So,
would that be?
Now this gets complicated because now you said you're a corporation, true?
I'm an S corporation.
You're an S corporation. So
Yeah.
You're not self-employed. You're
No.
not a sole proprietor. So as an S corporation, I assume you're being treated as an employee of the corporation?
No, I didn't go that far into it. I really didn't.
Well, so that's a problem. Right away, you can't do it.
No, because my husband and I are still on the same account. It doesn't really matter.
No.
We just have an additional paperwork that we have to file.
Okay, now there's two issues now. The first issue is, as an S corporation, the way you get paid is through wages. The corporation has to withhold Social Security tax, Medicare tax. The corporation has to withhold state and federal income tax. The corporation has to purchase a federal and state unemployment tax. You'll need workers' compensation insurance. Are you doing all of that?
It's done at the end of the year.
Well, no, you can't pay yourself once at the end of the year.
No. It's just the taxes that are withheld at the end of the year.
Are you being treated as an employee? Or do you have a payroll system that you're using?
We have no payroll system in place because it's just me.
Okay, but are you filling out quarterly 941 forms?
My accountant is.
So, all right. Well, I'm a little nervous about that.
It's work. It's between myself and my accountant, and that's
okay. All right. So
we've never had an issue with that.
Let's take the next step. How many different checking accounts do you have?
Only one now.
Okay.
It used to be different, but it's
I understand. So this is a secondary problem. Then we'll go to the third step. The secondary problem is one of the primary reasons why people incorporate is to protect their personal assets, right?
Right.
But in order to do that, you cannot commingle your funds. And you
I'm
are,
not incorporated.
you just
An
told
S
me,
corporation is not incorporated. That's entirely different.
no,
Oh,
no. Okay. If you said the word S corporation,
Right.
that means you filed paperwork with your Secretary of State's office
I did.
to get yourself an S corporation.
Right.
If you haven't done that, then you're not an S corporation. You're a sole proprietor.
Oh,
And if you are a sole proprietor, then it doesn't matter. We don't worry about the step 2 about commingling funds because it doesn't
oh yeah,
matter.
no. I think you're right. I think I said it wrong. Sorry.
So which is it?
So,
Are you an S corporation or not?
no, I'm a sole proprietor.
Okay. All right. So you don't have to worry about commingling funds.
No,
You can keep the money in that bank account and you're fine, and you pay yourself. So now back to our example, whether you use it for 2020
right.
or whether you pay yourself means exactly the same thing tax-wise. It's
Right.
just, one, you have to keep records to show the mortgage and how much you're
Do
eligible.
I have to list, or should I list on the spreadsheet that I'm keeping just to show what I'm paying for this grant as a note to the spread that that's what it came from?
Yes,
Oh, okay.
yes, yes. And then you're going to be fine.
Okay.
All right. Anybody else?
One question, can you hear me?
I can.
So I actually pay myself rent instead of the mortgage. I put it aside and I pay myself rent because I am an S corporation.
Ah, all right. So just to be clear, as an S corporation, is the corporation doing withholding taxes on you?
Yes, I have a payroll through
Terrific.
Paychecks. Paychecks handles everything. I have my girls, myself, and that's what we do. But also the paying rent part is tricky because how do I show that I'm paying myself rent? I just write myself a receipt?
So if you're truly, the corporation is paying you, the homeowner, rent.
Yes.
Are you doing it
And I have to
monthly?
pay taxes on that every year.
Are you doing this monthly?
Yes,
Okay, all right. So the corporation shows the income.
yes.
The corporation can deduct the rent as long as it's reasonable rent. And then
Right.
you, as the owner of the home, would report that rental income on a Schedule E as a landlord. And then
Okay.
you can claim some of your house expenses on Schedule E.
So I told my accountant I need a Schedule E because she puts me in as paying rent already. I mean, I'm 30 years into this.
Well, for the corporation to be able to deduct the rent, which you want, you have to say this amount of money is going to the corporation
Right.
to me every month. This $400 a month, whatever it is rent. It's a corporate deduction, not a personal deduction. Your personal tax return should show a Schedule E because that's where the income should go
Right.
for rent. And the rental profit is not subject to Social Security tax. So there is a tax benefit to paying yourself
Rent.
rent.
Right. All right. I just wanted to
Yeah.
see if it was better to pay myself rent or to increase my income or pay myself. better.
It's better to pay rent,
Okay. That's
you
what I was
can't-
hoping you'd say.
but you can't just say it's now $5,000 a month rent.
No, I'm
Okay.
reasonable. And it's been
Okay.
pretty much the same thing over the years.
Okay,
So I'm just concerned on how to show that I'm paying.
So- well, do you pay it by check? How do you pay it? How does the corporation pay it?
Though the corporation doesn't write me a check, I use it to pay other things and I post it as rent.
Well, for purposes of the stabilization grant, you should have for each month that you are getting this money, you should make a notation that says so much of this stabilization money, $400, $500, $600 a month, I don't know, whatever it is, that's being transferred to another account or you're labeling that as, I'm sorry, you said you're a corporation. So you need to transfer the money or write yourself, have the corporation write a check and submit it to you and be making a note that this is stabilization rent money.
So what if I haven't been doing that so far?
Well, when did you start getting the stabilization money?
Just when it first came out. So I'd say the past 2 months.
So just go back 2 months and make a note that says back in August, whenever, this $400, $800, this was rent under the stabilization grant. You do that each month. Make a note that this amount of money, whether it stays in that account or goes to another account, you're identifying a certain chunk of this money as rent.
And where am I writing that note?
On a piece, take out a piece of paper and
Okay.
say, November
All right.
3rd, $2,000 comes into my checking account. That 2,000 of that is rent, and on a piece of paper, and you
Okay.
date it.
Simple. All right.
Simple.
Thank you so much.
Sure. Question, I have an LLC. Can I still pay myself? Well, there's several kinds of LLCs. There's a single person LLC or a one person LLC. If that's what you are, then you're treated exactly as if you're a sole proprietor, and you can pay yourself in exactly the same way that I just said. If you are a corporate LLC, an S corporation LLC, a C corporation LLC, then you need to have this money flow through the corporation, through the payroll withholding tax system until it gets to you. How much can it be? All the amount of money. It doesn't matter how much you're earning now. It doesn't matter if you only have one child now. It doesn't matter if you've never earned more than $2,000 a month and suddenly you're showing $5,000 additional dollars, whatever, for that month. None of that matters. None of that matters because it's all income. Whether you show it as income in 1 month or 6 months, it doesn't matter.
So how would I show it how would I flow it into the account? The money is coming into my business account as it is.
And are you,
So
are you incorporated?
I'm the question, the LLC. I'm the LLC who files as an S corp, if that makes sense.
Yes, it does make sense. Therefore, the income is coming to the S corp. The S corp must report it as income. The S corp then can either pay you a bonus every month. For 6 months, you're getting a bonus, or it can raise your wages, your salary, for 6 months. And then you, as the employee, now report that after the payroll taxes as income, and you're paying taxes on it. The corporation can deduct the amount that they're paying you and their payroll taxes. So the money's only being taxed once in the end by you.
Okay, so the money comes into my business account, right? And I'm going to report that as income, right?
Correct.
Okay. Then I'm going to, because I'm on the payroll, so then I'm going to pay myself that money, right? And then that's going to generate deductions and all that good stuff. And so then you're saying I should track that to deduct it from my taxes?
Well, in this situation as a corporation and you as the employee, the records that you would keep, first of all, corporation is showing this as income, $10,000, $20,000 of income. The corporation is now passing that on to you, assuming you want it all passed on to you, in the form of either a bonus. So you get the stabilization check on tomorrow, November 4th, of $3,000. So you could say, corporation is giving me a bonus of $3,000 for this month. It must still pass through payroll tax withholding. So you're not going to end up with the full $3,000 because they got to take out Social Security, Medicare tax, and they may want to increase your tax withholding, federal and state income tax withholding. But in the end, you're getting whatever's left over after those taxes, and that's income to you. Corporation has deducted it all first, and you're the only one that's going to end up paying income taxes on it. All right.
Okay.
All right. Question: our nonprofit nursery school is part of a church, different tax ID. We pay the church normally a donation, which is essentially for use of the building. If we suddenly call it rent, does that mean the church must be suddenly taxable? Well, yes, you want to designate this donation as rent now for these 6 months you're getting the money. This church will not lose its tax exempt status because renting their space is still part of their mission. And nonprofit organizations like churches don't pay income tax. So the church gets the money. I'm sorry, you get the money. Sorry, you get the money, income to you. You pay the church rent, and you want to do rent because now you can deduct the rent. You can't deduct a donation to a church as a charitable contribution. That is not a business expense. So,
But we're not taxable either.
right, the church is not taxable. But
And we're not either.
And
because
your
we're a branch
nonprofit
of it.
is not taxable either. That is true. That is true. But I would still call it rent. Just, it's a cleaner thing. Now, if the church doesn't like that at all because they feel like it's messing them up in some way that I can't think of, then okay, fine, church. It's still a donation. It's never going to be taxable to them. It's not going to be taxable to your nursery school program because you're nonprofit. And so you're
Doesn't
just
matter.
It doesn't matter. All the other money that you're getting, you can do, to meet your mission, buy more stuff, do more things. It's not going to make any difference. It's not going to end up being a taxable event to you.
Tom, I have
Okay.
a question that I've received from a school age program director. She called and said there's a school age program. They got a decent amount of money, maybe $150,000. They're in a school building. They don't have access to a permanent room. They don't have permission to make any changes on the playground. And they were having difficult time figuring out what they could spend the money on. Do you have any suggestions?
Okay. And this program, I forgot if you said this already. Is this a nonprofit?
I don't believe so, no. I think it's a town, it's run by the town. So the town pays a lot of their expenses.
Well,
It's a school age program.
yeah, but the question is, what's the business structure of that program? It's either a sole proprietor, somebody owns it as a person. It's a partnership, it's a corporation. It's got to be one of those.
Annie,
And-
are you on? Because I'm talking about you. Anne Marie?
She's saying the town owns the program. Well,
Yeah.
if the town, did the town get the money?
Sorry. Yeah, the town got the money. We got a lot of money, but yeah, we're gonna ask the school if we can update their stuff, but I'm not sure what they're gonna say. I was looking at like we usually have like our staff wear clothing that says our logo on it. We could probably do payroll because the town pays us. They're gonna put all the money in a separate account. I have to keep good records because we get audited. We're a government agency. So I could give bonuses.
So the town, if the town owns the program,
Yeah,
then,
it's a licensed daycare, but our name is the town of Putnam Valley.
but are you an employee of the
Yes,
Chuck?
I'm an
You're not a-
employee of the town and we run a
the town.
childcare program.
Of the town, not of the center.
No, of the town.
Okay, well, so the town got the money. It's
Yeah.
income to the town. The town can use it for expenses associated with your program. They can give you bonuses. They can raise your salary under the terms of the grant. And
Okay.
once you end up getting it, whatever, if you're getting anything as an individual, of course, it's income to you, and they should run through any bonus or raise of wages to pay you through normal payroll.
Oh yeah, they'll do everything like a government. We just wanted to make sure we could do that and buy toys and.
Yes, yes,
You know.
yes, absolutely,
Okay. Okay.
absolutely.
Okay. All right.
All right.
Awesome. Thank you.
All righty, last call. Anybody else? All right, you work hard. You work harder than I do. I appreciate all the work you're doing. This is a pretty unusual, unique opportunity to get all this money. It's a lot of money. And so people just need to think it through as to what's the best use of the money. So that's all I have to say.
Thank you, Tom. I appreciate
Thank
your
you.
time.
It's very informative.
so
Thank
much.
you.
Thank you very much.
Bye.
And a reminder, if you have not applied for the grant, you still have time. You have until November 30th. Give us a call to Child Care Council. We'll help you through the whole process. Thank you so much, Tom.
Okay, good
Thank
night.
you.
Thank
Bye.
you. Thanks, Tom.